G'day there, Investorholics. Today we'll be taking a look at the best Asian focus ETFs. We want to know the Asian ETF investment landscape, so I've chosen 4 here for us to take a look at. Asia's been one of the best regions in getting COVID-19 under control, anyway, to this point in time. So, the future might be something different. And that's kind of aided in them getting their economies mostly back to normal. Over the long term, I think Asia could be a region that delivers good economic growth, which should be helpful for the underlying businesses, and therefore if we're invested in those businesses, that'll be good for us as well. So hang around and get some more info on Asian ETFs. Asian focused ETFs, I should say, to be clarificational. Hey there, Investorholic. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up. And also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, this is what I call the gene pool. So here's the 4 we're going to have a closer look at today. So we've got IAA, which is the Asia Shares Asia 50, VAE, which is the Vanguard Asia ex-Japan shares index, Asia, which is a BetaShare Asia Technology Tigers, and then we've got CNEW, which is the VanEck Vectors China New Economy ETF. That one's probably the only one that's kind of only focused on one country, where the other 3 are a bit broader, but I thought I'd throw that one in just for a bit of variety. Of course, there are a few others floating around, but these are probably the first 3 of the 4 bigger ones anyway. So we'll have a look at the market cap and that type of thing at the end anyway. But let's have a run through these now and see what we can learn. Okay, so let's take a look at Vanguard, which is VAE, the Vanguard FTSE Asia ex-Japan Shares Index ETF. Investment objective here is to track the index, returns the index of the FTSE Asia Pacific ex-Japan Australia and New Zealand index, with net dividends reinvested in Australian dollars before considering all the fees and expenses and all the rest of it. So the ETF provides low-cost exposure to securities listed in Asian countries, excluding, as we just mentioned, Japan, Australia and New Zealand. The ETF is exposed to fluctuating values in foreign currencies, as there will not be any hedging of foreign currencies in the Australian dollar. Y factor, competitive long-term performance. Vanguard's investment approach provides investors with an efficient way to capture long-term market performance. Obviously, with these ETFs, we get some diversification. The fund invests in a diversified portfolio of securities, which means the fund is less exposed to the performance fluctuations of individual securities. As always, we like low-cost investing. The fund has low ongoing fees, as Vanguard strive to minimize the cost of managing and operating the fund. So Vanguard is definitely one of the cheaper fund managers around, or ETF managers around. Definitely a company to take a closer look at in general. Okay, so at the time of my research, we had a net asset value per share of $77.97. Trading above that at $78.76. Market cap just over $350 million. Management costs per annum of 0.4%. They have a distribution quarterly, January, April, July, October, which is nice, some money in your pocket. Dividend yield is relatively low, but these things are looking for higher growth anyway, so 1.83%. This one might be suitable for buy and hold investors seeking long-term capital growth, international diversification, and someone who has higher tolerance for risk. Obviously, that risk is associated with developing Asian countries. The ETF has over 1,439 holdings, so it's definitely well diversified. Your biggest holdings are Alibaba, Tencent, Taiwan Semiconductors, Samsung, AIA, that one there I can't really pronounce, depending or however you say that anyway, Reliance Industries, JD.com, China Construction Bank, and Ping An Insurance. We will see the rest of those on the next slide. Okay, as mentioned on the previous slide, we've got the top holdings here, looking at Taiwan Semiconductor, Tencent, Alibaba, Samsung, and AIA. Performance-wise, it hasn't done too bad. It's actually done quite well. The ETF has delivered annual returns per annum of just under 12%, so 11.9% since inception in December 2015, which has included issues like trade wars as well as COVID-19, so it's done pretty well. Technology makes up 32%, China makes up 40%, Taiwan makes up 16%, so you can add those together depending on what you think. Korea makes up 14.9%, India makes up 11.1%, and Hong Kong is 8.5%. According to Vanguard, it has a PE of roughly 17.8%, which is not extremely high, but it's kind of pushing the higher side. You also have a earnings growth rate of 12.3% and a return on equity ratio of 14.4%. So not too bad there. Yeah, definitely I think one to have a look at, just for the sheer fact that it's performed so well over the short term. But as with all these things, it's really hard to tell what's going to happen in the long term. But I think one to have a look at, just for the sheer fact that it's performed so well, one to have a closer look at. And I think it can definitely add value to your portfolio. Okay, let's have a look at iShares Asia 50 ETF. The fund aims to provide investors with a performance of the S&P Asia 50 index before all the fees and expenses. The index is designed to measure the performance of the 50 leading companies listed in China, Hong Kong, Macau, Singapore, South Korea, and Taiwan. The index consists of 50 leading blue chip companies that are drawn from the 4 major Asian markets, which you just mentioned. The index is a float adjusted market capitalization weighted index, so including only the largest, most liquid equity securities domiciled in the 4 aforementioned Asian markets. So it's actually quite concentrated, I think, anyway. I mean, you're going to get concentration with just 50 companies in the portfolio, but something to it's country focused as well, which reduces diversification, but it also gives you exposure to the, I'd say, probably some of the best, if not the best, future leaders in driving global economy anyway. So definitely one to have a close look at. Not that I would be too worried about owning it, just because it was so condensed anyway. So we had a net asset value of $17.03 when I did the research, trading just above that at $117.97. Market cap, this is probably the biggest one almost, I think, in this presentation anyway. $863 million. Management costs is not too bad, 0.5%. You get a distribution which is semi-annually in January and July. Dividend yield, it's not too bad. I mean, it's not, doesn't shoot the lights out, but it's pretty reasonable at 3.58%. Because as I've kind of said with some of these other reviews, these type of ETFs, we're in these for the growth, not the dividend. So we're looking for higher growth opportunities. So having exposure to only 50 stocks, the fund exhibits significant concentration levels in terms of stocks and geographic exposure. Sort of kind of what I touched on before. So IAA is the largest exchange traded fund in the Asia X equity segment. So kind of mentioned that as well. Holding only the largest stocks in Asia, the fund carries a tilt towards large caps, which have outperformed the other market segments. The fund feeds into the US domicile version of the strategy. So pretty much what this does is it, if you look at the holdings, it buys the US version of this. So whatever it is, IAA or whatever it is, it's listed on the NASDAQ, I'm assuming. That sort of reduces any paperwork, because previously there was a lot of paperwork associated with this, owning this ETF, but not anymore. So yeah, you definitely get exposure to, or cost-effective exposure to the 50 largest companies in Asia, and I mean that definitely can't be a bad thing, because those companies and these regions are going to be driving global growth and demand in the coming 20 years or 30 years or wherever it's going to be. So BlackRock's iShares business is one of the global leaders in indexing and possesses expertise in tracking and trading efficiencies. So also have a look at VAE and ASIA. They're definitely ones worth a closer look as alternatives. We also always should be doing our research and looking for alternatives, because the first thing that we see may not be the best. Okay, so we're looking at Tencent, Taiwan, Alibaba, Samsung, AIA Group, top 5 there. The rest sort of tails off a little bit. So since inception, we had a 8.17% performance, which isn't too bad. So if you'd invested on the very first day, your $10,000 would now be over $28,000, so up 182% or thereabouts. Performance-wise, if you'd invested in the last 12 months, you definitely would have seen some massive uplift. So if you bought 12 months ago, you'd be seeing 32%, which is pretty phenomenal in 12 months for an ETF. So PE, we're looking at 22.3. So that's quite high for the PE ratio. Anything over 20 these days I think's a bit on the expensive side. Price to book, we're looking at 2.47 times, which I think is sort of telling me it's a bit expensive as well. Historically, this ETF has been a strong performer, outperforming the equity Asia Pacific ex Japan Morningstar category benchmark MSCI AC Asia ex Japan index, effectively consistently over its lifespan. So there hasn't really been a time that's dropped in below there. Most of the outperformance came in the past 3 years. The coronavirus pandemic has caused considerable upheaval in the markets, and like I said, that's what I sort of pointed out, that 32% before. particularly during March and February of 2020. We're sort of sitting here in May now, so you know you'd definitely be, if you'd bought 12 months ago, you're definitely looking at some pretty healthy gains. Despite witnessing a sharp correction, the fund has now recovered all its losses and stands positive. Like I said, you know, you run at 32% in the last 12 months, not to be sniffed at if you actually got in at that time. So Morningstar thinks that this share class will be able to deliver positive returns above the category benchmark index. So Morningstar give this ETF a bronze rating, which is pretty good. Bronze is like 3 out of 5 stars. So, you know, it's in the middle, but these ones always have a lot of risk associated with it. I think that's probably one of the reasons why it's not a silver or gold. Okay, let's take a look at BetaShares Asia Technology Tigers. Asia, which is a pretty catchy little code there. Investment objective: Asia aims to track the performance of an index comprising the 50 largest technology and online retail stocks in Asia, obviously excluding Japan. That includes Alibaba, Tencent, Baidu, and JD. So we're getting exposure to Asian tech giants, gaining exposure to the technology tigers, leading the Asian technology revolution. So definitely we're chasing growth here. Due to its younger tech-savvy population, Asia is surpassing the West in terms of technology adoption, and the sector is anticipated to remain in growth phase for quite a while. Global diversification is always good. So one trade, ASIA provides diversified exposure to a high growth sector that is underrepresented in Australian share market. So pretty much we're just trying to get some exposure to something that we can't get if we're just solely buying here in Australia. And complements any investments you may have in the US, so US technology exposure. Okay, so BetaShares Asia Technology Tigers ETF. We had a net asset value of $11.17, trading just above that at $11.25. This one has a market cap of $659 million. Management costs is getting up there. I think this one's almost the most expensive of the four, 0.67%. You get a distribution in January and July, and it's pretty low, 1%. Yeah, so pretty much if you're paying, just as an example, if you're paying 0.67%, that if you've got a $10,000 investment, that means you're paying $67 a year. Just to give you guys a bit of a visualization of what 0.667% is, if I can get that out. So Asia is a reasonably cost-effective solution for investors seeking exposure to Asian technology sector. But with all these sort of Asian technology ones, you're going to get, especially the more broader ones, very, very similar top 10 in all of them, because all these big Asian companies are actually technology companies. So that's just something to keep in mind. So investor can gain exposure to the top 50 largest Asian technology companies, obviously excluding Japan, in a single ASX trade. Asia aims to provide long-term capital growth potential as a primary driver for returns. The fund can be used to introduce regional, sector or asset class diversification to a portfolio. We should always do some more research, so check out VEA and IAA. So we're looking at Tencent. Taiwan Semiconductor, Samsung, Alibaba as the top holdings there, all clocking in at 10% of the fund. We're looking at returns here since inception, pretty good, 30.46%, pretty good I should say. That's actually quite phenomenal. Over the last year, so if you'd have bought just after the most recent crash, sort of March, anytime after March, sort of into April, May, you would have done 60%, so over 60%. So the top three sectors in allocation here are internet and direct marketing, retail at 25%, semiconductors at 21%, and interactive media and services at 18%. So top country allocations, obviously these ones are all pretty similar. China at 49%, Taiwan at 24%, and then South Korea at 19.7%. So the beta technology range has been designed to provide investors with access to the most exciting technology themes from around the world in a single ASX trade. So this one's performed quite well over the lifespan here, so definitely one to keep an eye on, one to do an ETF to do some further research on. Pretty phenomenal since inception of September 2018. So I mean, it hasn't been running long, but if you can keep up at half this, if you can do 15% per annum for the next 10-15 years, that's massive gains for the shareholder. Okay, let's have a look at CNEW, which is a VanEck Vectors China New Economy ETF. CNEW gives investors a portfolio of the most fundamentally sound companies in China having the best growth prospects in sectors making up the new economy, namely technology, healthcare, consumer staples, and discretionary. So China New aims to provide investors returns before all the fees and rubbish, obviously tracking the index. So the index is the MSCI Market Greater China New Economy Index, and that aims to select the 120 companies in China with the best growth at a reasonable price attributes, which are considered to be the best drivers of long-term capital appreciation. So companies are selected based on the strength of 24 fundamental indicators across 4 factor categories. So looking at growth, value, profitability, and cash flow. As always, you've got to check the PDS to get the full picture. Designed to serve the basis for investment funds, providing access to investors to some of the most promising stocks in China. Why are we bothering? So obviously it gives you access to China A shares via the VanEck Vectors expertise in single trade in the ASX. Getting access to China A shares is very difficult for foreigners. A portfolio of 120 of the most profitable sound companies with the best growth prospects at the forefront of the Chinese transforming economy. Only includes companies from the technology, healthcare, consumer staples, and discretionary sectors. So they're definitely the higher growth sectors for the next 5, 10, 15, 20 years. Okay, net asset value here per share of $9.23, trading just below that at $9.20. Market cap, this one's relatively small in the scheme of things, $77 million. Management cost, I think, is quite high, but as I mentioned, to gain access to China is quite difficult. So if you want this type of investment, I think you just have to suck it up and pay the very high management cost of 0.95%. You get a small distribution annually in the middle of the year, which is July. Dividend yield of 0.88%, which is not overly exciting. The ETF gives exposure to the Chinese economy through an investment in 120 of the fastest growing and most fundamentally sound companies in China. As we know, China can be opaque. Their accounting rules are different. How much do you trust what they actually tell you? This is a way of kind of hedging that bet and having 120 in your basket. If a couple go broke because of dodgy dealings, hopefully the other 118 or whatever are pretty sound companies. So the Chinese economy is set to become the largest in the world, as we all know, going to overtake the US. Therefore, most of the growing companies will come from China. However, China is not without its risks, and caution is advised. So, this one you maybe would keep your exposure, sort of below 5% or 5% or below in your portfolio. I think you should be fine. Have a look at IZZ or CETF as some alternatives for investing, but I think you're mad not to have some exposure to China in some way. Definitely going to help your portfolio performance in the long run. Yeah, so pretty good performance overall since inception, 28%. In the last 12 months, you will have done 13%. So not as good as some of the other Asian-focused ETFs, but I think this one that gives you direct exposure to only the best growing Chinese companies, I think, is the way to go. Definitely worth having a small exposure in your portfolio to just keep an eye on what's happening, and you can quite possibly build into a larger position for this one. Okay, let's have a look at the verdict. So I think if you invested some money in any of these ETFs, you'd be doing pretty well in the long term. If you invested some money in either the VanEck Vectors China New Economy or the BetaShares Asia Technology Tigers since inception, I think you'd be doing very well. But having said that, those ones haven't been running that long, so you're only looking at 2 or 3 years for those ones. So time is still young. For me, since inception, I'd be putting my money probably into the Vanguard Asia FTSE fund. Lower cost. I think it's been running long enough now to get a bit of an idea about the overall performance and robustness of the ETF. So, I'll be pretty happy with getting 11.9% every year for the next 30 years. How long the Chinese economy takes, Asian economy takes to develop, I should say. So I'd definitely be more a buyer of that one, to be honest. But what I'd do is then I'd buy a small portion in the BetaShares Asia Technology Tigers, and say 5% of my portfolio in Vanguard fund, and then a smaller percentage, couple of percent in the BetaShares Asia Tigers, just to top it up, because you're going to get some good performance over the long term. But having said that, there will definitely be some overlap in the top 10, because I think they're probably going to be pretty much the same. But if you want to take on the risk, extra risk I should say, I'd just go straight for the BetaShares Asia Tigers and just see how it runs for the next 3 or 4 years. If you can get anywhere near 30% for the next 3 or 4 years, just stay with it, because I think that's going to be a pretty good long-term ETF to be in. Gives you exposure to Asia, the top 50 Asian technology companies. So I think they're going to be by far the fastest growing companies in Asia, and it's sort of the second largest fund now as well. So it's only been going for a few years and it's already overtaken the Vanguard fund. So definitely, if you want to take that extra risk, I'd just be putting my risk money into BetaShares Asia Technology. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. Because KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.